Welcome to the Infinite Mindset Podcast, the show where we explore the power of the infinite banking concept and how to take control of your financial future. I'm your host, Andy, along with Scott and frequent guest Jared. We're here to help you think bigger, build smarter, and create freedom on your own terms. Let's get started. Welcome, everyone, to another episode of the Infinite Mindset Podcast. Myself, Jared, and Scott. This is the Christmas episode, so hopefully you are at home with family and friends having a good time, or you're with a good crew celebrating. And with that, I'll hand it off to you, Scott. Where are you at right now on getting your license and getting appointed with the NNI?
Yeah, I got my fingerprints done. Those were submitted to Wisconsin, so I'm just playing the waiting game on getting the license in hand from Wisconsin. I think they get like 90 days to process that. Though it's holidays, so we'll see how long that takes. But that's the last step. Everything's applied for, fingerprints are in. After we get done with this, I'm gonna reach out to the guy that's gonna be my mentor, see if I can start the NNI stuff, or at least the process of it, without that license physically in hand, or if they need that to start. So reach out to him, and otherwise, just waiting on Wisconsin to do their thing.
Okay, cool. All right, with that, we'll jump right into it. So we're going to be talking about cash value. Where is my money really is what we're getting at. And so first off, it's good to kind of look at a few definitions so people understand what we're talking about. And so looking at what is cash value is actually very simple. It's the present value of your future death benefit. And so some people kind of maybe listen to that and like, well, what do you mean? And so another way to look at it, it's what would the company give you right now if you were to let them out off the hook and not have to pay your death benefit. And so that term, though, is actually called the cash surrender value. And you'll see that when you look at your contract. And it's constantly growing as the policy gets older and older, because if you think about it, you're getting closer and closer to the end of your mortality. You're going to be getting closer to your graduation date. So if the company can give you less money now so they don't have to pay that death benefit, that's how they can get out of the contract. Now, they don't actually want to do that. It's just kind of conceptually the way that we want to look at this. Another way to look at it, sometimes it helps people this way. It's the present. It represents the equity that you've built up in the asset. In this case, the asset is your whole life policy. And it's similar in the way that you would build up equity in a home if you were paying down a mortgage. But for me, conceptually, the way I like to look at this, when you're paying down your mortgage, you're paying down the debt. But when you're actually paying premium and you're growing your cash value, you're actually building an asset. So it's a little bit different than the home, but that's kind of how I like to look at that structurally. Anything else you guys want to add there?
No, really, really important point there that you're paying down debt when you're paying the mortgage, but you're building the asset as you're growing this. Like perfect description of that.
Yeah. Depending on if you're in the US or Canada, we're just going to focus on the US though. You have something called the policy endowing. And what that simply means is that the death benefit is going to equal the cash value. And so in the US, typically that's around age 121 now. It used to be age 100, but we're living longer and longer. And it could still vary a little bit by company and the different products, but that's typically what we're looking at. So when you think about this, if you can get the death benefit higher, right, eventually your cash value has to equal it. So ultimately that's going to bring your cash value higher as you go along the way. And so when I think about this and how that cash value is getting to the death benefit, I think about it in two different ways. There are two things that are driving that cash value higher. One is time, and the other is your death benefit actually increasing. So what I mean by time is if the cash value has to equal the death benefit at 121, the more time that you have in this policy, the higher the cash value has to be, because ultimately it's going to equal that death benefit at 121. And the other side of it is increasing the death benefit. So if I start off at one point, then I can get that death benefit higher. Well, I know that at 121, that cash value still has to equal the death benefit. So by default, that cash value has to keep growing to get there. We're going to dive into it a little bit more. We're just looking at definitions, but if you conceptually can think about this, it's going to make the rest of the conversation we're going to have that much easier to track. And Jared, I like this. You brought this up before when you said it. Cash value is not the same as cash. It's a value. It's not actually cash, right?
Yep.
We'll look at this a little bit more, but that's important to really understand because we're going to talk about what you're leveraging and what you're doing. But if you can look at it as a value and not actually a pile of money, it's going to be a little bit easier for you guys to grasp.
Yeah, and when I first saw the word endow, I was still kind of tied up on the modified endowment contract, and I had a hard time differentiating the two of those, right? But they are two different things, right? The modified endowment contract is totally different than a policy that does endow or the cash value reaching the same amount or value as your death benefit. When I saw a picture of a sideways triangle, it's not linear, but the cash value grows to reach where the death benefit is over the life of the contract. I think this gets so foreign because we're used to, a lot of folks are just very comfortable with term insurance, right? This is a whole life policy. This is all the way until your graduation date. So that cash value is constantly rising. Like I said, it's not linear, but it's constantly rising over the life or the time as you described.
So that's great. I want to jump in there too because I don't want to get too far down the road of the mech, but I think it's really good to talk about it because we're here. So you have an endowment and then you have a modified endowment contract. So
Yes.
all policies are going to endow at some point, and these policies are going to endow when they're supposed to, according to the IRS for the tax benefits, which is 121. When you have a modified endowment, it just means that the cash value is going to equal the death benefit at some point prior to that age. And when that
That's right.
happens, you lose the tax benefits. So that's what we're
That's
getting
right.
at there. It
Yep.
just grows
Well
too
said.
quickly according to the IRS.
Yep. I just remember getting confused by that when I first read that word. Not from us talking about it recently, but when I'm learning about this and what these policies look like, or how they're structured, I got so confused and tied up on that. So that, just wanted to highlight that there's a learning point.
No, I've heard that before too. That definitely makes
Yep.
sense. So I want to come back to the two things that I talked about, the time and the death benefit. So we'll do the deeper dive now into the cash value actually built. So when I'm talking about time, the way I look at that is actually the interest or the guaranteed part of the policy. And then when we talk about increasing the death benefit, we're talking about premium. That could either be premium you're paying out of your pocket, or it could be premium that's coming back as a PUA or something like that. So I actually ran an illustration. This was pretty cool. And I wanted to isolate just the interest. So I did a 100% base policy. And instead of taking the dividends to buy PUAs, I used it just as cash going back. So it was only the interest that was growing the policy. And it performed as expected. I did a paid up at 95. So at age 95, all the premium was paid in. The death benefit never changed, right? Because I'm not buying more death benefit with the dividends to do the PUA. It was just there. And at 95, the interest kept growing. And at 121, the cash value exactly equaled what that death benefit would be. But something that was kind of cool looking at is even with this boring vanilla policy that wasn't paying dividends, or excuse me, it was paying dividends, but the dividends were not being used to purchase PUAs, the amount of extra cash still going to the owner was actually still fairly significant. So these policies, even the boring ones, with enough time, actually do get pretty efficient and will generate a decent amount of cash flow coming in. All right, so the other side of this is the premium, and this is where the majority of the growth in your cash value comes from. And it's either going to come out of your pocket, so this is what you're used to, whether you're doing a monthly, quarterly, semi-annual, or annual payment. This is the premium that's coming out of your pocket. It's going to keep the policy in force, and depending on how it's structured, it may buy some additional PUA as well. And then the other side of this, and this is also premium, it's your dividends that are coming in. And typically the way we recommend it and the way that the NNI recommends it is for those dividends to buy PUAs or paid up additions. And you can look at these as little micro policies that mimic the initial construct of the other policy. They're fully paid up policies in the short term. And so what happens though is you do this is all these things are buying more and more death benefit, whether it's your premium or these PUAs coming in, whether you're paying the PUA or whether the dividend is being redirected towards it, and it's growing the cash value. And so by default, your cash value has to just constantly get bigger so that when it endows at 121, it's going to equal that. And so,
I have a question.
yeah, jump
I had
in,
a
jump in before I
question,
finish this up.
like a
Go ahead.
legit question, like a learning moment for myself. PUA buys, PUA gets added, and your death benefit rises as you redirect your dividends towards your. It doesn't. The only way that it affects cash value is that the death benefit rises, and as time goes on, the other part of this equation takes place, and you have more access to your present value of your future death benefit is what's rising. So it's rising together essentially. But I guess the big question is the PUA buys more death benefit is the starting point for that.
Exactly.
That's
Yep, that's
that's
spot on.
exactly right.
Okay.
It's usually viewed as like a one pay. When you do a paid up at 95, you're gonna if you're 45 years old, you're paying for that insurance over the course of the next 50 years. Whereas when you add a PUA, you're adding it right now. It's a one pay policy that mimics exactly the same policy that's already there. And depending on the company, you're going to get a high percentage of the cash value. Let's just say 90% for the sake of a number, where you're going to get about 90 cents for every dollar that's going to increase your cash value. That varies between company and product and whatnot, but you have increased your death benefit and also increased your cash value because you've increased the current value of your future death benefit.
And something to jump on here, this is actually really important to talk about. The PUA increases your cash value significantly in the short term, but not in the long term. The
That's right.
base over the long term is what will increase that cash value. So that's why we do these ratios. We look at people's age and their life expectancy. And so the higher the PUA in a policy, the earlier cash value. But eventually, if you have a policy that's heavier in base, in the long term, you'll have more cash value in that policy over time.
Yep. Well
Okay.
said.
So,
Yeah,
Did that
and
answer your
so
makes
question?
sense. Yep.
cool.
Yep.
That's a great question.
Yeah. Great.
So for anybody out there, and if they want to look at their illustrations so they can put their eyes on this and see what their own contract is doing, you'll see premium coming out of your pocket, which is the contract premium and the premium outlay. One is just going to be your annual. The other one is going to be what you've done over the term of the entire contract. And then on the left side, you're going to see your guaranteed or interest side. And I kind of have this as my time portion. Just even if you don't do anything else with PUAs over time, this thing has to grow to what your current death benefit is if you don't grow the death benefit. And then on the right side, excuse me, you're going to see your non-guaranteed or your dividends. And if directed properly to buy PUA, that's going to be what really grows that policy as well. And then a little bit, I just want to talk about this on the left side there. You will, or not the left side, but on the premium, you'll see the contract premium or the premium outlay. Depending on that structured, you will have base and PUA mixed in there. So just to clarify, part of it will buy the base, which will be that interest part. And then you'll have those little PUAs like Jared mentioned before, which are those little micro policies that just keep jumping and building it as well. But ultimately, all of these things interacting together is what's going to grow that cash value.
Yeah, I really like how you broke that down between the interest on the guaranteed side and the dividend on the non-guaranteed side. That really hits the easy button and takes a lot of the confusion out of these. I don't typically put numbers on an illustration in front of someone until they're right about ready to finally pull that trigger because there's just so many numbers. It's confusing. What am I looking at? What does all this mean? So that just really hits the easy button. I like how you described that.
Yeah, and the truth is too, we can make these numbers dance, right? I want to make sure that conceptually people understand what's going on. I do want people to understand what's going on with the numbers, but if you're a good agent, you know what's going on. You could manipulate things. I'll just put it that way, and that's not our goal.
Sure.
We want to make sure people actually understand the construct and what's going on here.
Exactly. Exactly.
Okay, so hopefully you guys have a good understanding of the fundamentals. If you don't, come back, reach out. We're happy to clear any of this up. But I want to move on to loans because, my goodness, if you go out there on the internet and look at this stuff, people think, oh my goodness, if I finance my car through my policy and take loans, I'm going to get rich buying cars. No, this is absolutely not true. It's very simple. There's so much noise here. But, and I call magic, it's not magic, it's just the way that these policies work. The benefit here is because it's cash value and you're not borrowing your actual cash, is that when you have a loan out, that cash value is still growing uninterrupted in the background. The only thing that will maybe affect it a little bit, and we've talked about this before, we did one of the webinars, is direct versus non-direct recognition. If you have a direct recognition company, they will lower your dividends slightly depending on how much of a loan you have out. If you have a non-direct recognition company, it will not affect the dividend at all. And you can do a quick search on that. That will clear it up pretty quickly. But ultimately, the key is being an honest banker, is paying back the loan like Nelson talks about, at least at the rate that you'd pay back the bank, preferably higher. But paying back the loan does one thing and one thing only. It replenishes the cash value so that you have access to it again. And it also will ultimately lower the amount of interest you're paying to the insurance company the longer it's out. And so that hopefully clears that up. Taking loans, I want to say this again, will not grow your cash value or make you rich. It does not work that way.
And if you go back to your previous point about building the asset, not paying the debt, that ties in exactly with what you're talking about here, right? So you're you're paying back your asset. You're replenishing your asset. A lot of folks see the loan and they think debt, just because that's kind of the way we've been programmed. We take out car loans, we take out whatever loan you're going to take for. All of that fills into the idea that it's a debt. Whereas if you're playing honest banker and you're paying yourself back in the same way that you would have paid back that debt, you're going to replenish the asset that you've built.
I love it. It's a really good way to say that. Scott, anything you want to jump in with?
No, are we going to talk about like the interest rates on a cash value loan and what and why, or
I didn't have it, but if you
is
want to
it,
jump in, feel
it,
free to jump in here.
it
Yeah.
I know one of the questions I get asked, well, you got to pay interest on this, and I'm like, well, two things. One, it's simple interest. You know, it's you can pay back principal first. It's simple interest calculated by the day. The other part of it is this money. The way the insurance company works is they have to essentially put that money out there for loan to make the money to get you the dividend to. So if they're not doing it elsewhere, if they're not doing it for you, they have to do it elsewhere. So in order for these policies to work, there's that. And the way I look at it is it's like an administrative fee. It's like I'm part owner of a business. I'm paying a business for management. If I'm not doing it, then if they loan a block of money out there to a bank or something like that, the bank is paying the administrative fee, but somebody has to pay it for this whole thing to work. I think the magic for me is I know it's not my money, but I view it as such, like you guys are saying, and then you pay it back faster. Nelson recommends pay it back at least how you're going to pay a bank back or pay it back faster. And that drives that. Some people see, oh, you have an 8% interest rate. Well, I can get a car loan. I was like this when I started. I had this conversation with the guy that's going to be my mentor. Why would I go take out a loan if I can get 2% at a bank? And he's like, well, we started doing it. And it's like, okay, if you calculated out the interest I paid versus pulling it from my savings or putting it through a policy sequencing, is like as I'm building this system and seeing how it all functions. I don't know really how to put it into words other than it makes complete sense because it's a different type of interest. You pay it down faster. There's actually less interest charges, less finance charge. Like the total cost of financing at the end is significantly lower than going through a traditional method just because of the way it's done. So,
You bring up a really, really good point there because a lot of folks get wrapped around the axle on the interest rate, right? They're like, what is the deal? 6 to 8%? I can totally beat that in the marketplace. And yet, us as someone that understands a lot of the concepts that Nelson has taught, we get that you're already saving that 34.5% by creating this system and by becoming your own banker.
mhm.
And so if you're already saving that 34.5%, whether it's costing you 2% or you're saving 2%, that's pennies on what you've already saved, right? So as someone sitting in our little room here, we understand that, but not everybody gets that. So it's really, really important question that you just asked because you hit the nail on the head. This does not always get understood or grasped or otherwise. And I think to build on the concept that your mentor said is you're in the position of power by having this asset. If you chose to go take advantage of that bank loan or the car dealer loan that's 2%, cool. Maybe you saved a couple of percentage points. Maybe you were maybe that's a valued cost to you to be able to go through their financing. But you also have built the asset that you have the ability to do that by your choice, by your power if you want. You are not required with only one option to go down to the car dealership and get lucky that they have the right financing set up because you don't have any other options. You're in the position of power. So you can go either way on that, but it really comes down to when it's your capital, control it.
Yeah.
I think the other thing to point out is I just relate it to vehicle purchases because that's how I was looking at it before. Now I'm at the point where I'm looking at I take a policy loan for cash value to create more money than it's ever going to cost me to borrow. And so I'm not looking at it from a purchasing point as more of an investing standpoint.
Yep.
Really, that takes that another two steps farther down the road.
Sure.
Now it really doesn't matter because you're generating way more than it'll ever cost you.
And
Uh,
while you still have the opportunity to borrow from your cash value, literally 2 weeks after the check clears, you can use these cash values right off the start. It's not going to have equaled what you've really put into it for a couple of years. So there's also that business setup startup, right? You've got to understand what you're doing. A lot of folks get really wrapped also around this idea that I just started it. It should be, this high producing asset right now. So, well, hold on. Well, you just started. Give it some time. You got to think long term and get beyond the first year or two to realize what you've really built in terms of an asset.
Yeah, like you guys said, it comes down to control and options and the fact that it is still growing in the background, even if you're leveraging it, which is huge. And so if you get that, you really do understand it. And with that, I'll dovetail into why the companies even let you do this, right? So why is this advantageous for them? So I did a little bit of research here. I thought it was pretty cool. It's kind of interesting. Every time I do this and I look back, I always find a little nugget. And so the newer one that I found here, I didn't realize this, was back in May of 1777. So we're going back a long ways. There was an early American life insurance company, and they actually voted to loan 5,000 pounds to the Continental Congress for the Revolution in support of that. So that was the first. There may be something out there before that, but I didn't find it. This is what I found was the first example of a loan from an insurance company. And then this kind of set up the framework going forward for us as owners to actually access that. So by the early 1800s, it started becoming more mainstream, and this is what we really care about as owners. And the companies, they weren't doing this out of the goodness of their heart. What was happening was people were going through tough times, or they had an opportunity and they had the cash value there, but they had no way to get to it. So they were surrendering policies to get to it because they had to do something else. And for a life insurance company, you're looking at this is a bad deal. We're losing customers. So they come up with a way, well, how do we keep the customers but let them access the cash value? And they realize this is the most secure loan that is out there because we're either going to get, we already have the money, right, that you guys have paid in premium. We're going to limit the amount that you can take in loan based on how much cash value you have. Or if you pass away, there's going to be a death benefit that comes, and we'll just subtract what you have out and then collect. You'll get the difference, but we'll collect what we need to there. So it was really a way to keep these policies in force. But then the government came in 1905, you had the Armstrong investigation reforms. And what they said is no, not only should most companies be doing this, we're going to contractually make it so that all companies do this so that people have access to their cash value. And that actually ended up being huge when you had the Depression and a bunch of other stuff that came in the 30s and the other stuff after that. But basically, to sum it up, it's beneficial for the life insurance companies, but it gives us as the owner an incredible tool to finance the needs of life.
Full history there. I had no idea that it went that far back.
Yeah,
1777. That's
that was the
impressive.
first one I found. Yeah, it's like doing this stuff because you find some neat stuff that when you're having to
That's
talk
pretty
about it.
cool.
Yeah. So with that in
It
mind,
kind of adds the no. You said that other little nugget when we talked. These companies have been around for some of them 100 plus years, paying dividends, and then you see something like this, and it's like, oh, geez, 1777 was when it what you found could be the earliest start of it. So
right, and that was
Right.
here in America. I don't know other areas, other countries that they had going on, but I only care about here because that's what we're writing and that's what we're doing. So yeah, America. Anyway, so with this, and we're talking about a lot, and when you're taking this loan, there's a lot of confusion here. People get very hung up. What money are you actually borrowing? And that's why we were stressing cash and cash value early on. So you are borrowing money from the insurance company. You are not borrowing the actual money in your individual insurance policy. And so, Scott, you brought this up before, and that's what got us down the whole loan conversation, right? But the company must invest the money that they're taking in somewhere, and they have to meet basically about two main obligations. They have the death benefit payouts and the other expenses that come with operating the company. And you can break that down. I don't want to go into all the little stuff that could be, but it's everything else. And both are significant. But one option the company has, and we talked about the Armstrong Acts and the rest of it, is to loan the money out to policy owners. But not only can they do that, contractually, you're first in line. So if you want to get to that money or that cash value, you're first in line to get it, so you have access to it. All the cash value does is it serves as collateral that guarantees the loan. And we hit on that already on how that works out. But this is actually huge for us, and this is a huge bonus. This is what allows that cash value to actually grow uninterrupted because you're not actually borrowing the cash value. That's just the collateral that's out there. So you're never actually interrupting it unless you're talking maybe direct, non-direct recognition, but that's just a minute point. Either way, even both of those are still growing. And then, so to sum it up, this is one of the ones, and you'll hear a lot of people talk about, well, when you graduate, and when we say graduate, when you pass away, your beneficiary only gets the death benefit and the company keeps the cash or the cash value. And so I crack up, and really it's a lack of understanding. And the critics don't even understand what they're saying when they're talking about this. And so the best way that I found to illustrate this to people that maybe don't understand is to compare it to something that you know. So this would be the equivalent of saying that you paid off your mortgage, right? You sold your home. And then after you got all the cash from that, you went back to the bank and say, oh, hey, by the way, remember all those mortgage payments I made? I want to get all that principal back that I paid you as well. And so it just doesn't make sense. I think when people hear that, kind of light bulb goes off. Hopefully it is. If not, we'll come up with another analogy. But the other thing to look at here is also when that death benefit does get paid out, it's going to be many, many multiples of whatever your out of pocket payments were or that premium that went out, especially if it's designed properly. So your beneficiaries are going to be way better off than if you just had that somewhere else. And the whole time we can get to this, and this is kind of what we were talking about earlier, that cash value. If you're doing the right things with it, not only are they getting that death benefit, but hopefully they're getting all the other things in life that you built and financed, hopefully investments in other business entities that you were able to do because of that cash value that you had along the way. Anything else you guys want to add there?
Yep. Well said. But even if your house isn't paid off and you just think about that same example, maybe you've got a $500,000 home that's got 250,000 in equity. When you sell that home for 500,000, you don't get the 500,000 and the 250 in equity. That's just not how that works. You get the equity you've built up into it. So maybe you had a HELOC out. Maybe you had borrowed against that equity. Well, they're going to take that equity back from you from the sale price whenever you sell that home. I know we were really careful at the beginning to differentiate between an asset and a debt, but that example is spot on. It's perfect to help understand you're leveraging an asset to borrow against. And if you are leveraged against that asset when you graduate, well, they're going to take what you owe back and then pay the rest of the death benefit to your beneficiaries.
It's a great way to sum that up. Scott, anything else you want to add before we finish it up?
Nope, that's it.
Okay, cool. Well, thanks everybody for listening. Merry Christmas. Hopefully you're, like I said, you're with family, friends, or a good crew, and we'll catch you on the next episode.
Merry Christmas, y'all. See ya.
Merry Christmas.
Thanks for tuning into the Infinite Mindset. If you found today's conversation valuable, share it with someone who's ready to think differently about finances. And don't forget to subscribe. Your journey to financial freedom starts with the right mindset.